Hey everybody, Chris Urso here with URS Capital Partners and URS Properties. So welcome, doing our Q1 2025 video update. Sorry, find a good spot for that. Uh, it's May 20th right now, so some of the information is a little bit dated, but I also have a quick recap towards the end. Wanted to make sure we get this out to remain consistent. Where now I think this will be our 7th or 8th quarterly update. As kind of the world started to shift, we felt it was important to continue to do these updates, provide real insight to what's going on in our portfolio, also what we're seeing in our markets on a day-to-day basis. So want to go ahead and get started. I'm going to jump right in. So for those of you that don't know us, URS Capital Partners was founded in 2009. We acquired our first 40-unit apartment complex in Cincinnati, Ohio. We've since gone on to do 29 additional acquisitions and 4 ground-up development deals. We've sold 23 of those assets since inception, and we have just about 270 active investors across our current portfolio, and which is about a little over 2,000 units, 2,200 units across 10 assets and 1 student housing property. So our average hold time on our sales was just about 40 months, average equity multiple of 2.07, and average IRR of just shy of 33%. So big takeaways that I wanted to kind of rehash. So if you haven't received our 2025 Outlook report that I put together at the end of 2024, feel free to reach out to Rebecca at URS Capital Partners. But thought it was important because a lot of this really played out. The first quarter was very challenging, as was Q4 of 2024 for us. So you're going to see as we go through some of our KPIs that we feel like we were in the thick of some of the most challenging operational times that we've seen in probably the last 15 years, give or take. Since we started the business back in 2009. So want to share just a couple of things here. So some excerpts from the report. Supply hits a 50-year high. Why now is the time to buy? So supply is real. We've taken the view that supply in most of our markets was peaking between Q4 and Q1 of this year. But why we're bullish on acquiring, we've now acquired 8 deals since the beginning of January 2024. Why we remain bullish, even though there's some operational pressures in this environment, is that we're looking at all the data in our markets and we're seeing new deliveries pretty much have peaked between Q4 and Q1 of 2025, and we're seeing new starts tremendously deteriorate on a go-forward basis, which will result in new deliveries falling off a cliff when you're looking out 27, 28, 29. So we think that the assets we're buying today, we're able to take advantage of the dislocation that's currently in the market as a result of some of these operational pressures and supply peaking, and get great basis, good value, and put a 3 to 5, 5 to 10 year hat on with the assets that we're acquiring. We think we're going to be really well positioned when you look outward through kind of the back half of 26, looking through all the way to 2029, because supply again is deliveries are peaking today and new starts are at pre-pandemic levels back to 2019 levels. You have to remember what we're seeing is basically 50-year highs of new deliveries in multifamily. We will most likely not see this level of inventory be delivered throughout the remainder of our career in this business, possibly our lifetime. A lot of this was a direct result of 0% interest rate environment coming out of COVID. Free money, faucets were open with debt, faucets were open with equity, and multifamily was kind of the darling. We're seeing 10, 15% rent growth year over year. People thought that was going to last forever, and you saw developers come pouring in because money was free flowing towards them. And we don't expect to see a 0% interest rate environment anytime soon, if at all, throughout the next 10 to 20 year cycle that we expect to see in multifamily. So we think we're really well positioned. One of the other things is that we are continuing to make investments in our portfolio, knowing that this year and likely the front half of next year is going to be a challenge, but we're operating our assets with a again, more of a 5 to 10 year horizon. So we're really well positioned. I'm very thankful we did not buy a lot in 21 and 22. We were selling the majority of our portfolio starting in 2019, leading into the pandemic. We thought the market was getting very frothy back in 2019. Pandemic hit, things kind of stabilized, and then interest rates hit zero. And in 21 and 22, values took off, and we sold about 12 to 13 deals during that time. And we only acquired in 21 and 22, we acquired one asset, one value add asset. Our developments that we do with a long-term mindset. We're building institutional quality product. We're not building merchant building. So we're building very bespoke type of unique developments, not builder-based kind of merchant product that is built to sell, essentially, build it, fill it, sell it model. We are building it, looking to stabilize it, refinance these assets, and then maximize value over the long term because they're institutional quality assets. So we believe that we're very grateful. We've had our fair share of challenges, over the last 2 years. We're not immune to it, but we're very grateful that, our portfolio as a whole, we have a lot less challenges than the majority of other operators in our space that are in the private capital space that bought 10, 15, 20, 30 deals. Some instances, almost 100 deals across a 3-year window from, 2021 to 2024. So we're very grateful that we kind of minimize that exposure, and we are prepared for this. So everything that you're going to see in these updates was not a shock to us, and the numbers are not great, but that's part of my commitment to our investors and to those of you that are looking to invest with URS Capital, is that we're doing these updates, good, bad, or indifferent. But I want to reiterate, as you can see here, I printed back in December of 2024 that we believe that, the first half of 2025 is going to be the peak of supply, and we're in the throes of it, and it's going to take another 12 to 18 months to absorb that inventory. So we're prepared for a challenging first half of 2025. However, we do believe that we're going to see outsized rent growth over the following 24 to 36 months as demand begins to outstrip supply again. So that's a big part of our thesis. This chart just reinforces some of that. I'm not going to spend a lot of time, but I thought it was really good here. What it's showing you is the markets that had, the high supply markets that experience negative rent growth when they're expected to have peak annual deliveries. And you'll see a lot of these markets. So, Nashville was kind of Q3 2024. Atlanta was early in the process, Q2 2024. You have Raleigh is Q1 2025. Charlotte is peaking Q3 2025. And then this shows you have declining rent and vacancy, and then stable vacancy and positive rent growth is the yellow. And if you look into kind of Q1 2026, almost every market except for Austin and Salt Lake City are going to start to see stabilized vacancy and positive rent growth. So it kind of reinforces our thesis that we put out there at the end of last year, that we know 2025 is going to be a little bit of a challenge. 26 should start to get better, but really outward looking towards the back half of 26 into 27, 28, 29, we really feel like we're going to be in a very good position. And this just summarizes, completions expected to slow considerably following the marked slowdown in construction starts, right? There's been a lot less starts as a result of higher interest rate environment, flattening to declining rents, very hard to raise equity. All of those things combined have made it a challenge for developers to start new projects in this environment. So again, as we continue to look out, this is an excerpt from our report. We're looking to take advantage of the market dislocation that's going on as a result of a rising interest rate environment, a high supply environment. We're seeing great basis, great value opportunities to be acquired today and put that 5 to 7 or 10 year hat on. So buying good assets in good locations at anywhere from 20 to 30, some instances 40% discounts to the peak environment of 21 and 22, but looking to get those deals to a stabilization where we can produce, steady 6 to 10%, very tax efficient cash flow. And then that will give us a free call option on when we want to sell assets in the future in the optimal times. So, everything that we're buying today, again, we're looking out and not saying, hey, we're not looking to flip a deal in 24 to 36 months. We're looking to buy. Do we want to own this asset for 10 years? Do we want to be in this market for 10 years? Or recapitalize appropriately to own it for 10 years? And we think this is probably the best buying opportunity we've seen since we started this business, to come in and get great relative value in really great, fundamentally sound markets for the mid to long term. And that's really, our underlying strategy that we're implementing right now. So I do want to highlight, and we had a pretty busy Q1 all around. So we brought on some amazing team members over the last 6 months. First one I want to identify is Tom DiGilio. He's come on as Asset Management and Development Associate. He's been a fantastic addition. Comes with a great background working with a multifamily developer that covered the Southeast. Tom really did everything from pre-development to project management to post-construction asset management throughout the lease-ups and stabilization of his portfolio. Really great background in our space. Has been a huge addition in terms of like taking ownership of the portfolio, doing the deep dives, doing the analysis, doing the forecasts, and his sole dedication is asset management and supporting Mike in our development efforts, on an as-needed basis. Another huge addition to the team was James Foote. He came on in December as our lead analyst. Fantastic addition to the team. Great experience, great pedigree. Graduated University of Binghamton. Great experience with a family office and one of the larger crowdfunding platforms. So he got to kind of see everything from the ownership side to equity placements to all different aspects of deal flow. And he's been an absolute machine on the acquisition side. He's allowed us to stay so close to the market. In this environment, we're bringing in anywhere from 1 to 2 deals a day that are getting scrubbed down to see where to put our energy. James has underwritten probably close to 200 deals now since December, and we've acquired 1 asset since December. So he's allowing our acquisition machine to be running almost 24/7, building our pipeline out, allowing us to stay super close to the market. Also want to recognize on the ops side, Michaela Brown. She's now started with us. It's been about 6 months for her as well, and comes from a great background in the hedge fund space as head administrative officer and investor relations. She started pre-money with the former hedge fund she was at, and by the time she left, they were over a $1 billion hedge fund. So she got to see kind of every aspect, and she's done a huge job on coming in and helping us really implement processes and plans and organization for not just the management side, but the investment business, and joining forces, really, being the liaison between the two worlds. She's based out of here in New York, but works very closely on the property management side and implementing, again, hiring processes, culture processes, cash flow forecasting, cash calls for each asset, managing, escrow accounts and everything in between, supporting our site teams and our leadership teams on the property management side. So very lucky to have her. All around, just huge impact and great addition to the team. And our most recent team member addition is Katie Zawak. She comes with over 20 years experience in the property management side as a senior regional manager. She came from a very large national property management firm. She's based out of Charlotte. She's managed 5,000 plus units in her portfolios, led teams of 25 plus team members across everything from Class A, B, C assets. Really strong financial background, understands budgets and financial forecasting and models, and also really knows how to build out teams very well. So she's been great. She's stepped in and taken over as senior regional manager, part of our portfolio that we're calling it the coastal portfolio, which includes Savannah, Charleston, Wilmington, and has been will continue to be a great addition to the team as we continue to grow and scale. So now let's get into the update portion of this. So try to put that there. One announcement for the quarter: we did have a new acquisition. As I said, we're super excited for this asset to bring on. Great example of dislocation that exists in today's environment. The Palms at Edgewater, 288 units, 2023 construction. We acquired this from the original developer who started the project in 2020 and completed it in 2022. However, due to an issue with how their water line was built out and an easement issue, they were unable to get their COs until that was resolved. So the building sat empty for almost a year, so it put them dramatically behind schedule and leasing up in a very different environment than they originally anticipated. So they spent about 2 years, they had to refinance their construction loan into a very expensive bridge loan, which was coming up for maturity. We'd been tracking the asset for almost a year and a half. And ultimately, after 2 previous buyers fell out, we got tapped in and were able to close the transaction in 60 days from start to finish with agency financing. Property was just touching up on 88-89% occupancy when acquired. And we believe we got a very, very attractive basis at just about $203,000 a unit for a 2023 vintage in Somerville, South Carolina, which is suburban Charleston. Supply in this particular market is pretty much at the tail end of deliveries, and there's nothing forecasted within the next within 5 to 10 miles to be delivered, over the course of the next, 12 to 18 months. Whatever's been delivered is currently in lease up, and this particular submarket, there's us and 3 other assets within a 5-mile radius. So we feel like we're really well positioned to step in. We'll take the asset to the next level. This was a merchant builder that was the seller, so they don't necessarily think the way that we think when it comes to a little bit more long-term and operation. So we're going to take some of the amenities to the next level, create the true look and feel of a Class A asset. It has all the amenities. It's got 9-foot ceilings, great site, beautiful, beautiful site. One of the nicest sites that we've had in a very long time. So excited to bring this one on board. So now on the operations side, you're going to see occupancy at the close of the first quarter versus the close of the fourth quarter. So we've seen some meaningful dips in some areas and some increases in others. So occupancy at the close of Q1 for Belmont Heights, which is located in suburban Charlotte, we closed out at just about 91%, which is down from 95% in Q4. The Creekside portfolio as a whole maintained about 95 to 100% occupancy. This is a workforce portfolio we acquired in November of 2024 from the original developer. All like early 2000 vintage, but small assets, but collectively is about 100 and I believe, 86 units, 74 units, 62 units, and 50 units, kind of in a triangle throughout the Asheville market. And this was really a workforce housing play where the rents were pretty much the lowest in the entire Asheville market. We bought it from the original developer who was retiring, and there was tremendous upside in rents to be had that we're incrementally getting over time. We're not forcing vacancy, but you'll see some really great numbers on this. So very happy with that. Crescent Place, this is one that's been a little bit challenged on occupancy. We feel like we're turning the corner. We did a big renovation. This is the one deal we bought in 2022. And it's not so much that the price we paid was wrong. It's the one deal that, I kind of broke my values on and fell into the trap of easy money where there was tons of term sheets being thrown at us. We had 5 or 6 lenders competing for the business, one wanting to give us more money than the next. And, this as a result, we did a little bit more leverage than we normally would do. And interest rates went from 3.5% to 6.5% on this asset while we completed a $5 million renovation, in less than 24 months. We did a massive renovation on this property. We took the rents from $980 to $1,500 in 2 years. We were able to refinance our bridge loan, thankfully, but now the market kind of has caught up on the supply side. And we really outperformed on rents in our first 2 years, and now we were a little bit late to react, which you'll see we're starting to see the upward trend here. We were a little late to react on pricing. We had gotten such strong price growth in our first 2 years that we kind of missed that the market had pulled back on pricing and waited probably 1 quarter too long to make the necessary adjustments. And now as we've implemented a fantastic daily pricing software and expiration management software to our entire portfolio, we're seeing the benefits of that already take shape. but it kind of mucked along. Where you're going to see we had some bad debt hangover here that we needed to clean up. So we had actually a pretty decent, if you look at the numbers here, 22 net leases for the quarter. Sorry, let me go back one here. So we had 22 net leases for the quarter, which is really not too bad. But we had some bad debt cleanup that we needed to realize in the form of evictions, skips, and move-outs. So that kind of kept us stagnant, and we're starting to turn the corner there. Flats at Leland, this was a distressed asset that we bought. We ended up October 1st, call it. We took over the asset. It was only about 20 some odd percent occupied at time of closing. The property was pretty much neglected and abandoned with no staff, no oversight for about prior 6 months, but great vintage asset built in the early 2000s, and we were able to acquire it essentially for the debt that was owed on it, which was about a $9 million discount to the previous sale. So just about 30% from the prior sale. And we've stepped in and we've cured all the deferred maintenance. We've turned nearly 80 apartments to make ready from inception. First 3 months was all about kind of curing deferred maintenance, cleaning the asset up. And then you'll see now Q1, we took occupancy up almost 20%. And we had a little bit of kind of hangover move-outs in April, but now we're kind of ticking upwards towards, I believe we're leased out at 50% as of May. So, happy with the progress there. Our goal there is to see incremental occupancy growth of about 7 to 10%. We're not as focused on rents as we are as focused on occupancy there. Latitude at South Portland, kind of stayed pretty stagnant. That's a seasonal market in that the winter months tend to be a bit slower. We're seeing really good progress there as we move into kind of May, June, July, August, September. Exchange at Rock Hill, slight downward move there. Views at River Bend. Exchange at Rock Hill is now kind of, our goal is to get this property at 95%. The supply side is starting to wean gradually in and around Charlotte, especially closer to Rock Hill. And, we felt the pressures of that, throughout our lease up and throughout the last year, but now we feel like we're starting to get to the other side there. The Views at River Bend, this was a property we acquired late August. Big reposition, big value add. We bought it from a long-term owner. They had the asset for 15 years. It's 2001 construction. Pretty much everything was original. So we went in and blew out the amenities, gym, clubhouse, party room, marshfront area, redid the whole pool deck, added grilling, patios, decks, all new furniture. So we spent the first kind of 4 to 5 months through that transition, weeding out some of the legacy tenants, and you'll see in the form of bad debt, occupancy is picking up, and we're getting over the hump, but we're in that kind of second stage hangover on the bad debt side. So where we're now kind of forcing some vacancy as we've started our interior renovation program. Farmhouse apartments, this has been a lease up for us that's been a bear. It's been kind of mucking around 85% for 6 months. We are officially on the other side, which we expected. We hit 90.5% occupancy yesterday, huge milestone for the asset, and we have 95% in our sites. But pretty much November through like March is really tough leasing season in and around Murfreesboro. But come April, May, June, July, August, we see tremendous velocity. Like you're going to see some huge numbers on the move-ins there and net leases for Q2 coming out of that property. And Cobalt Row is our student housing deal. We're 99% occupied. Those leases don't expire till August. And I believe we're just about 80% pre-leased for 25-26 school year there. So you can see here, this is actually our average increase on move-ins versus prior rents. So you see some of these are some pretty big numbers, 8.5% on 12 new move-ins for Belmont. And we also had number of renewals, 25 and 20 move-outs. So we netted more than 50% on that side, which is great, with an average increase of 6.3%. Creekside Arden, this is that workforce portfolio in Asheville. These rents were insanely low, the lowest in the entire city of Asheville. So we're seeing some pretty meaningful growth. We had about 19 move-ins there, which is almost 10% of the property. with an average increase of about 20%, so very strong relative. So again, we had 11 move-ins in the fourth quarter. So you can see here these numbers ticking upward, which is good. Renewals there, we're taking a lot of our month-to-month tenants and putting them on longer-term leases, so kind of netted about 50% with 7 to 8% increases there. And this is what I'm talking about on Crescent Place. It's pretty amazing. Like we did 18 move-ins in Q1 2025, and we had 4.8% increase on those prior rents, and we still maintained positive increases on renewals. They did a hell of a job on renewals, to be quite candid, for the quarter at 2.6%. But this is the area that we should have seen the trend better, to be quite candid, and sacrificed on rents because we had already achieved such high rents through our renovation and value add program. We should have dialed back those rents and gotten ahead of occupancy. So recognize that again. That was good learning for us. And I think with the investments that we've made in our software and technology, it's AI driven, live learning that goes on every single day is pulling data from all of our sites based on traffic, expirations, market information, comps, etc., occupancy goals that we have, and it's giving us proposals every morning on where our pricing should be, where our optimal lease terms should be to manage our expirations and exposure moving out. So I think it's taking a lot of manual data and processing it through machine learning on a daily basis. So we're very excited that that's in place. Flats at Leland, this is one, as you can see here, we're being smarter about occupancy. We're not so worried about rents in the short term because this is more of a longer game. Our goal here, we acquired this asset for cash. For those of you that aren't familiar, we acquired it for cash. I'm not so concerned about month over month pricing between right now. We have a goal inside of 18 months to have the property at 95% occupied, 90 to 95% occupied, and execute a cash out refinance to be able to return 60 to 70% of our investors' equity at that point in time. So we're more looking at this saying, okay, everything that we're doing today must drive the goal to refinance in 18 months. I'm not concerned if we have to strip back pricing because there's a property in lease up and we want to be the value proposition. We're doing that, and again, the software that we're implementing is actually helping with that dramatically. And the renewals here, it's going to be very stagnant. There was very low occupancy when we bought it, and then from that occupancy, even some of the folks that were paying, we're forcing to non-renew, which you're going to see some bad debt here too. Bad debt's really going to be kind of the underlying theme. Exchange at Rock Hill, was kind of still positive. Latitude South Portland, positive 4.2% on 24 move-ins for the quarter. They did a great job, heck of a job on their renewals as well, averaging 3.4% on over 50% of their renewals. Exchange at Rock Hill, 22 move-ins, still net positive 1.7%. This again, reason the occupancy pretty much stayed flat was, 24 move-outs, 22 move-ins. So we kind of net neutral there. That's what that's telling us on this side, right? Which is why occupancy didn't move that much across the board. But again, 3.2%, positive growth on our renewals. Views at River Bend, we're seeing good steady growth here as a result of our renovation program. 38 move-ins with an average increase of 5% over prior rents. Huge number relative to Q4 move-ins, right? More than double the amount of move-ins. So we're seeing our plan is starting to take shape. Again, we spent September to December really doing the renovation program, the reposition, making the improvements, the rebranding of the asset. That all takes about 6 months to start to mature. And then you have like kind of the first dip of evictions or bad debt or non-renewals. You start to incrementally grow. And then that second wave of expiration of legacy tenants that we choose to non-renew or don't qualify, we start to push out. So you'll see another dip. And then typically we get to the other side and it's a hockey stick curve upward. So again, positive there even on renewals. Farmhouse apartments, this was our quarter. Time to rip the Band-Aid off, not be so focused on pushing rents, but focusing on getting to that occupancy. threshold of 90 to 95%. So we sacrificed on outward facing market rents, some of the floor plans that had higher exposure. We ripped back the rents, said let's drive occupancy. And on renewals here, you'll see we had a lot of move outs. It's a pro and a con. It's great demos here. And it's in a submarket where there is a lot of home building as well. So the tenants that were leaving, it's not because they're not happy and don't love the asset. It's they came in, with a year lease and we're waiting for a home to be built. But we're seeing those numbers start to improve as we diversify the tenant base a little bit at Farmhouse Apartments as well. And renewals was at 1.2%. Cobalt, again, student housing, no new move-ins. We started the renewal process here, and we're getting some big numbers on the renewals. We should probably end up between 7 to 9% net at the end of this lease up for 25-26 in terms of year-over-year rent growth. So bad debt was the big story here, and a lot of this is the way that we also calculate some of the bad debt. So you'll see across the board, some meaningful numbers. I'm going to highlight some of the big ones, obviously. Crescent Place, this was a lot of hangover from Q4. So Q4 was very low through the winter months. These were evictions that carried over into January, February. So it could be, the reality is there's probably about 3 or 4 of those residents from what we looked at that carried more than 50% of that bad debt number. And that bad debt number includes not just rent, but early termination fees, damages, refunds of concessions that are baked into our lease terms. So it's not just rent. So when you see that number, it's not that we had, if the average rent was $1,500 at Crescent, we didn't have 20 residents that were evicted. That number that made up, again, the majority of that was probably a handful of residents, call it 3 to 4 residents that made up the majority of that. And we're going to that's probably going to not get that much better in Q2 there, but we think Q3, it will really be normalized out. And again, you have to look at bad debt on more of an annualized basis, and that's something that we pay attention to internally from a percentage of gross revenue. And for a newer vintage asset with higher demographics, we really want to be in that 1 to max 2% range. An older vintage asset like Crescent Place, where it's more workforce driven, tenants are a little more sensitive, we want to maintain that, call it 2 to 4% range. And we're looking at an annualized basis, we can maintain around 3%. We're pretty happy. Flats at Leland, this was really like the big charge off from a lot of the legacy tenants that just accrued and finally got them out and moved out. That was realized in Q1 from closing in October 1st, carrying large balances for non-payers, etc., late fees, delinquents, etc. So that number is going to be really small on a go forward as we've now got through the majority of the cleanup there. Latitude South Portland, nothing too interesting there. Views at River Bend, function of another big reposition. Inheriting kind of legacy tenants on that property, fleshing through, getting to the other side. That number is going to probably be decently high for the second quarter as well, as our renovation is being well received. And we started our unit renovations as well, and they're being really well received. I think we've done close to now 29 full unit renovations, 27 of which been leased at anywhere from $150 to $200 premiums. So as that is working and being rolled out at expirations of legacy tenants, we're starting to force some vacancy there. And then also as we're increasing rents, it's going to come with more delinquency from some of the legacy tenants there. Farmhouse Apartments, nothing too alarming. Cobalt Rose, pretty in line. You have to remember that's 750 beds on that property. That's nothing, again, it's pretty consistent, nothing alarming given the size of the property. So NOIs got dinged across the board. This was really painful, to review, but this is a direct result of the bad debt and softening on occupancy, where, we think this was kind of the worst of the worst that we're going to see for almost our entire portfolio, based on some of the trends that we're seeing and the improvements that we've made. So this was rough. This was a painful one to digest for sure. But again, much like bad debt, we have to look at NOI kind of year over year. We have year over year targets depending on where the deal is at. If it's a major reposition, that NOI growth is going to be, much higher expectation. If it's a stabilized asset, we want to be able to see consistent, 3-4% NOI growth year over year. But yeah, this was tough, but it's a direct result of a handful of things. On some of these assets, it's a little artificial, like Farmhouse and Views at River Bend. These are assets that were up for tax reassessments that haven't hit yet, but we start accounting for in January 1 to be prepared. So, for example, Views at River Bend, the taxes grew by almost $200,000. But this was known. Like, it's not a surprise to us. We have that planned for in our underwriting. But it's just we start accruing for that. So you're seeing bad debt, higher taxes all hit in one quarter as the renovation and revenue is starting to catch up. So some of it's a little bit overstated, but Crescent Place, for example, this is a direct result of operating at 87% occupancy with significant bad debt for the quarter. Those are the two things that drove that. We did a really great job managing expenses, operating expenses there. So there were some very positive takeaways. Exchange at Rock Hill, nothing too material there. Latitude South Portland, that was an occupancy driver for the most part. That deal is used to operating at 95, 96%. We think we're back there by the end of this quarter of Q2. Belmont Heights was occupancy driven, and we're moving kind of in the right direction on that front. So this was a tough one, but again, this is what we expected Q1 to be rough. I have to reinforce that, to both our existing investors and those of you that are watching this to kind of learn and understand. We're probably one of the very few groups, I know we are, because I talk to our brokers on a daily basis that are talking to the entire market, and very few groups are outward facing, sharing real information of actually what is going on. Operationally, it's a dogfight every day. We are talking to our teams multiple times a week. We are coming up with alternative ideas, being creative, being different, establishing goals for our teams on occupancy, on collections, on retention, on pricing. It's every day. There's no more the free ride and free rent growth, that stopped. Multifamily, in my view, has been in a recession for the past almost 2.5 years, if not longer, the sector as a whole. And when I say operationally, there's been challenges, right? Rent growth has been muted, negative in some instances. Brokers have not been earning what they're accustomed to earning. Transaction volume has been down 40-50%, year over year, if not more, from the peak of from the peak of 22, and it's staying fairly muted. So that trickles down to your brokers making less money, your lenders making less money, less financing out there, sponsors or investment companies, institutions not putting capital out because of the uncertainty that's going on in the market, and also in the macro side with political headwinds and tariffs, etc. Institutions aren't built to navigate through that. But all of those reasons are why we are leaning in very hard on acquisitions, because we think that it is a great time to be buying when that liquidity is on the sidelines and our sector has been feeling the pain. Unlike some other sectors or industries, we've been feeling the pain, and that's when you want to lean in. When it's uncomfortable, when it's uncertain, we focus on basis first in everything that we do, because when you have the right basis and you don't over leverage an asset, time can heal all wounds. We know that, and you could be surprised to the upside a lot easier. And we're underwriting based on today's metrics. That's 0% rent growth for the first 12 months. It's higher vacancy. It's more concessions. We're leaving ourselves room to be surprised to the upside in 26, 27, 28 in a lot of instances. So while this is red and bloody, as Warren Buffett says, right? You want to buy when there's blood in the streets. This was as bloody as our quarter could possibly be. But again, nothing that was overly surprising for us. And I think this is important to kind of put things in perspective with how our business works. Unlike equities and the public markets, everything happens immediate in the public markets, right? Our world is much slower to react, right? Our leases are longer duration in the form of 12 months. So, you don't see the hits on income necessarily. You have to look at it over a longer trail. So when you look at your trailing 12 over the prior year, Belmont Heights has a positive increase of $325,000 from our T1, our trailing 12 through Q1 through the prior trailing 12. Apologies, that's obviously a typo. We're not up 421% on that. I think that's 21% if I had to do the math the right way. But that's still huge. 21% NOI growth year over year. That's what our business plan was on this asset. We bought it from a company, a syndicator like us on the private capital side, but not really like us because they came into the business in 2019 and they were ex-doctors and dentists, etc., that started buying a bunch of properties, tried to self-manage, made a lot of money when the market ran up, and then time ran out, and all of a sudden they had assets left and they had no idea what it was like to really operate these things for the longer term. So they're getting out of the business completely. So we bought this deal from them at a very attractive basis in a great submarket, great loan assumption that was really undermanaged. Love Belmont, North Carolina. I love this town and wish we could buy more there. But strong NOI growth. Creekside Arden, obviously we don't have trailing 12 to compare to. We've only had the asset for 4 months. But even Crescent Place, who had a really rough quarter, is up 6% year over year when you're looking at it that way. Flats at Leland, obviously negative NOI. That was the distressed deal that we bought, so that number will start to come down quarter over quarter. Latitude at South Portland, again, not a great quarter when you look back. Latitude at South Portland was down 9% for the quarter, but year over year is still up 4%. And this is the more important number for us to track. Exchange at Rock Hill, again, didn't have the best quarter, down 3%, but is up 34% year over year on NOI. Views at Riverbend, we don't have that year over year comparison yet. Farmhouse Apartments in lease up, so this is artificially, we were leasing up the property last year, so when you look trailing 12 over trailing 12. And Cobalt Row, our student housing assets, up 7%, year over year. So big shout out to our maintenance teams, the guys that keep the wheels spinning behind the scenes. A lot of moving parts on a lot of these assets, the amount of move-ins, move-outs on a quarterly basis, work orders that they're dealing with. And these are not teams of 5-6 guys on some of these properties. Views at Riverbend, it's 288 apartments. There's a team of 3 there dealing with 300 work orders. Same at Farmhouse Apartments, Crescent Place, 1970s vintage property. The work orders at Crescent Place are very different than the work orders at Farmhouse Apartments, which is basically a brand new asset. The work orders at Crescent Place are plumbing issue, HVAC issue, hot water tank, a leak, real issues where, not that Farmhouse Apartments aren't real issues, but it could be, my cabinet drawer isn't closing perfectly, or my light bulb is out, my thermostat's not working. So a little less labor intensive, nonetheless still a high volume. It's a very big property as well, though, 288 units at Farmhouse Apartments. So just always want to recognize, I think people don't understand necessarily in our business the amount that goes into operating these assets to maintain a standard that we demand within our markets. And I say this all the time, whether our property is a Class A, B, or C asset, I want it to be the best it possibly can be, within its respective class, day over day. And it takes a lot of effort by the site teams to maintain that. So just to close out, because this is now almost 50 days from the close of the first quarter, just to kind of take that first chart and compare occupancy at the close of the first quarter to where we are today. So you're seeing some really positive momentum. Belmont Heights up almost 5%. Creekside Arden basically in the same exact, actually a little bit better, across the portfolio here, maintaining that 95-96% range. Crescent Place, some really strong movement in the right direction here. We feel like we've solidified our team there. We had some challenges with some of the leasing team there. We've made some adjustments, and we're starting to see the benefits of that. Flats at Leland, we're seeing that positive movement up again. I think we're actually, as of today, leased out over 50 some odd percent. Latitude South Portland moving the right direction. Exchange at Rock Hill, Views at Riverbend. Farmhouse Apartments, big kudos to that team. They have battled. This lease up was a bear, and very, very proud of them sticking with it. We're now over that major 90% threshold with our eye on 95% here in the next 60 days. So huge accomplishment on that front. But I think you're starting to see the trends of some of the investments we've made in people and in some of the software that we've invested into, with our attention that we're putting in, on a daily basis to our sites, navigating some of the challenges that we're facing, that are kind of headwinds that are beyond what we can control, that we're battling against. We're trying to do our best on a day-to-day basis to mitigate against that and position us really well to take advantage of the upside when that time comes, as the market begins to shift. I want to reiterate too, demand is not the issue. We are seeing really healthy demand across the board in our space, both from a macro multifamily demand level to down to each of the markets that we're in. This higher interest rate environment, while it creates some challenges in our space, it also creates opportunity. Homeownership remains very unattainable for the majority of the demographics that we're focused on renting to, which is, if you remember, our space is kind of the $50,000 to $120,000 household income demographic. Very challenging for them to go out and buy a home in this environment when you still have elevated interest rates and elevated home values. So we want to continue, our focus as we move into 25. We started the year off great with a fantastic purchase that really aligns well with our thesis and our strategy of buying quality product in quality markets, again, with that, mid to long-term view on it. So we're extremely active. We're very grateful. We have a tremendous investor base that understands our thesis and what we're trying to accomplish in this environment. And it just requires some patience, but there's some great opportunities out there, and we're going to continue to pursue those as they present themselves. We remain very disciplined, very picky in where we're going to lean in and what we're going to lean into. I think that's an important thing. I can't tell you enough, I'm going to probably include our pipeline maybe on the next quarterly update with the amount of deals that come in the door quarter over quarter. I think that's a great thing for us to track and show you from the acquisition side what we're looking at on a daily, weekly, monthly, quarterly basis to get to just the 3 to 5 deals that we might do in a given year. So we remain picky, we remain disciplined, and we remain value focused at the end of the day. I think that's the number one thing here. And we've got a great investor base that I'm very grateful for. We were able to build some new relationships on our last project because of the amount of equity that we raised. We finally had some capacity to bring in some new investors. We haven't done that in probably over 2 years, to be quite honest. We haven't really been able to bring in any real new meaningful relationships, and very fortunate that a lot of our investors have been with us for a very long time, and they're comfortable referring others to us. So I want to say thank you to all of you that have done that. It's going to be a good ride. It's going to be a little bumpy. We know that. We're prepared for it, but we are ultra bullish. I am 100% aligned with my personal strategy, investing pretty meaningfully in every deal that we've done since 2024, and want to continue to do so as the market continues to present some unique opportunities to acquire. So again, we're going to continue to focus within our markets that we've had a presence in. And if you're interested in learning more about URS Capital Partners, please reach out to Rebecca. She heads up our investor relations. She's happy to set up a call, provide any information. Again, if you want that, if you don't have that 2025 outlook, please just email Rebecca at urscapitalpartners.com, and we're happy to get that over to you. And I'm a big fan of Howard Marks. He's got a great little podcast out there, if you don't follow it, where he kind of does his memo and condenses it into 20 or 30 minutes. And one of the best quotes from him that I heard over the last few years was, "The worst deals or loans are made in the best of times, and the best deals or loans are made in the worst of times." And that's certainly where we're at right now, and we believe that some of the deals that we're acquiring here in this environment are going to prove to be some of the best deals that we've done in our 20-year history. So if you're looking to learn more about upcoming opportunities, again, please reach out to Rebecca at urscapitalpartners.com. Thank you so much.